Insights on 9th of November 2020. Business Insights is a very exciting webinar series hosted weekly on Mondays at midday by a panel of industry thought leaders for business owners who want to know and be on the know about the latest and most significant news and initiatives in the Australian business landscape and how that's going to impact them in business. Our panel of advisors aim to inform, educate and provide strategic insights to the changes in economic, legislative and financial landscape that affects small business. We aim to guide our viewers to navigate business challenges through COVID-19 and beyond. Now let's meet our panel of industry thought leaders today. I have Adam Lyle from BizDoctor.
Hi Sam, how are you? Thanks for having me.
Great to have you on board. Ian McLaughlin from Imperium Accounting and Tax.
Afternoon, Sam. Thanks for having me.
Thank you, and welcome Lisa Garrido from Enigma HR.
Hi guys, thanks for having me again this week.
My name is Sam Qureshi from MoneyClip, and we'll host this webinar to educate you and inform you. I should also provide the following general warning. The views and opinions shared on this webinar are designed to be general information only and are not designed to be taken as specific advice for your specific or personal circumstances. Please do reach out to any of the panel members or your specific people that you deal with in order to make sure that the advice is appropriate for you. Now let's get started. There's plenty of things that's happened in the last week or so, and why don't we get started straight away with Adam? And Adam, tell us a bit about what's going on the insolvency rules.
Yeah, thanks, Sam. Sorry about the initial noise with the truck going past. But first I'm going to say is God save the Queen. You know, thank God we have not the craziness that goes on in America at the moment, but that's fine. We'll move on. Does anyone know how long it is until the 31st of December this year? Just have a think about that. If you get about 6 weeks as your answer, you're about right. The government put emergency moratorium measures in place during the course of this year to help businesses get through the tough times. And that moratorium expires on the 31st of December. There's no indication that it's going to be extended, but it expires. Those emergency moratorium measures included a safety net for directors that they could not be exposed to insolvent trading attacks by any liquidators that were subsequently appointed for the duration of the moratorium. Let me just break that down for you. If you're an owner of your business and you own your own home, you're entitled in some way, shape or form, whether there's a mortgage or not. If your company goes into liquidation through no fault of your own, you know, you have a couple of suppliers fall over, a couple of customers don't pay you, and you really got no other choice other than to liquidate or put a formal restructure in place. The liquidator could not attack you for continuing to trade that business whilst it was hemorrhaging or whilst it was in trouble during the course of this period of time. They weren't allowed to do that. Those measures finished on the 31st of December, full stop. So if you continue to trade your business and you can't pay all of your debts as and when they fall due, and I'll come back to that point in just a moment, after the 1st of January, the house you live in is at risk. The house you're entitled, or any property that you're entitled for, is at risk. Because if the liquidator attacks you for the debt that was continued to be incurred and is successful in making you a bankrupt as a result of that claim, the trustee in bankruptcy will attack that house. So I'm trying to make this as simple as possible. Now let's just go back to the question of can you pay all your debts as and when they fall due? Do you have a debt with the tax office? 98% of all small businesses do. It doesn't have to be $1 or $100,000, it's just any debt. Have you paid that debt as and when it falls due today? If the answer to that question is no, then you haven't paid all of your debts as and when they fall due. Just one debt. It can be to the tax office. It can be for your power bill. It can be for any debt, no matter what it is. And as soon as you haven't paid one, you haven't paid all, and therefore a liquidator will attack you for continuing to incur debt beyond that date, and you are continuing to incur those debts. That means you are trading your company whilst insolvent, and under Section 588G of the Corporations Act, your personal assets are at risk. So I'm trying to keep this nice and simple for everyone to understand. That moratorium will lift on the 31st of December. How do you prevent this? Know your numbers. Get in touch with your accountant today. If he doesn't answer the phone, I've got a little tip for you. There's a guy on this panel here right now that will take your call. Pretty simple. You've got to know your numbers. And if you're asking for your accountant to give you the financials and he's giving you financial year 2019, go outside, take a big breath, punch the brick wall, come back, ring it in. I hope I'm pretty clear and concise with that message, but it is looming. I will be doing some more education about this in the coming weeks, but it's time now to start understanding what risk you're at if you're an SME, and I hope that helps.
Fantastic, Adam. Thank you very much. That's really, really great to cover off on that, and we appreciate you being on the panel to talk about these really important items about small business. Adam, just very quickly though, so normally I think 3,000 to 4,000 bankruptcies a year. Obviously, there hasn't been that many this year because of what's happened. So are we expecting that to double to normal? So 8,000, 12,000, triple? What's the expectation for next year?
In the normal year, you get 8,500 insolvencies, corporate insolvencies per annum. And conservatively speaking, I said when we first, I think in the first few weeks of starting Business Insights, that I expected that to grow to about 24,000 insolvencies in this next year. I stand by that. I don't think it's going to go down. The industry is actually expecting that. Banks have put on huge amounts of people in their credit recovery departments. ATO have put on, would you believe, 2,500 people nationally to collect debt. So if anyone thinks that it's going to be a free ride after 1 January, Happy New Year, by the way.
Yeah, so obviously going to triple the numbers. I think one of the advices you gave in previous webinars was that basically make sure that you're acting early enough, you know your numbers as you said today, and act early, don't wait. Yeah, so definitely don't have your head in the sand. So thank you very much for that. Okay, so on to all things employment, people and HR. So Lisa, what would you like to cover off today?
Thanks, Sam. And guys, I'd like to cover very similar to what Adam just talked about, with all of the changes that all of us in business have had to undergo since March with returning staff back to the workforce. This is about what the government is now urging offices to do. So the government is urging the return to office as soon as possible as the economy continues to recover. And it's because they believe that it's important for the Australian workplaces to get back to normal as quickly as possible. Next week, I'm going to talk about what does that really mean, what normal means. But with the borders reopening and positive signs for economic recovery, the federal government is urging all businesses to try and get their staff back to the office. So the Federal Industrial Relations Minister, Christian Porter, told Fairfax Media that it's important that Australian workplaces do this as quickly as possible, which includes getting them back into the office, as in our employees, if it's safe, as long as local health restrictions allow. Again, this is all about local health restrictions allowing us to do that. So the coalition government has consistently urged Victorians to move faster in lifting restrictions. However, the state's lockdown rules state that people who can work from home should continue to do so. The NAB recently became one of the first major employers to talk about the benefits of in-person collaboration such as better innovating for customers, learning from each other, and problem solving together. So they really are looking at returning to the way the things were before the pandemic. Again, I question that big time, and that is my opinion, because obviously COVID-19 has challenged all of us to think quite differently, work and act differently, and ensuring that we retain the best of what we've learned, basically. So many organizations are obviously also keen to get back to returning to the office, but guess what? Research suggests that many employees have enjoyed the remote working arrangement. So a research by Citrix has found that more than half of the Australian workers, that's 56% in their research, said they would be willing to accept, get this, a pay cut to return for 100% remote role whilst post-lockdown. Those who are wanting the big city living as beneficial to their career opportunities and progression has fallen down from 49% to 33%. That is a massive change, despite the fact that the government urging us to wanting to return back to work in the normal office space. So nearly half, which is 49% of the Australian office workers, believe that productivity levels are higher when working from home, an increase of 16% compared to March this year, which was 33% at the time. Additionally, 44% Australian office workers have abandoned city dwellings or plan to do so because they can now work remotely. So an all-Victorian organization called Binofo, the company has been following the policy that if you can work from home, you should work from home instruction, which I find the best policy to abide by at this stage. So what that means, as I've talked about in the last few weeks, is adopt a flexible working culture arrangement and think of how you can work back together again where needed, and then adopt that policy. So whilst organizations are moving back into premises, I suppose, in Melbourne, this particular organization have already turned their minds into retaining the physical distance where they need to, obviously looking at a COVID safe plan, and then enforcing or implementing a return to work plan where it is necessary. So that my belief, ladies and gentlemen, is my belief in terms of what all organizations should be doing from now, even until after December. Have a look at where you can return to work, implement that, and where you can continue to work remotely, continue to do that if your employees are asking for that arrangement. I will talk more about the how COVID-19 has in fact changed the workplace worldwide next week. That's it for me.
Okay, great. Thank you, Lisa. Great word of wisdom there. I'm wanting to find out, would a catalyst be a change in the government stance from 4 square meters per person to 2 square meters? Because I understand that that's a big issue from an office perspective.
Again, it all goes back to the health regulations, and until we have some kind of vaccine, that per square meter ruling will remain the same, and it's not going to change. I don't see that going to be changing, regardless of what an organization would like to do. And I think that's the reason why in some of the industries, the organizations that actually look at changing an office fit out, they're booming. These organizations or these businesses have a lot of work ahead of them, because I don't think until we have that vaccine, as you guys have already been, I don't know whether you've heard the news on the weekend, there is a vaccine that they're looking to put into production without the comprehensive testing required just to prepare for this. And this is obviously, I believe, as a move to actually encourage the return to normal workplace. My argument really is that it will not return to normal because in the last 9 months now, close to 10 months, people have actually enjoyed and have been productive having this flexible arrangement. So I think it's wise and prudent for all businesses to look at that hybrid situation.
Okay, great. Thank you very much, Lisa. And now on to Ian. Ian, please enlighten us with all things tax.
Thanks very much, Sam. So the first thing I want to cover off today is that there's been a problem so far with the JobKeeper October declarations from an ATO point of view. So basically, there's been a system-wide inability to select the tier for the employee or eligible business participant. And this is just because the ATO systems are obviously struggling. So that's really important because, as we've talked about before, the tier 1 rate is the 1,200 or the 2,400 a month, and the tier 2 rate is the 1,500 a month. So the ATO has indicated that they are working on resolving these errors. They have kept the final day for lodgement for those October declarations still as the 14th of November, as it is every month. However, I would not be surprised if the system issues keep up, that they might extend that, but I'll update people on that. But just on that, so we are the 9th of November now, so we're really only 5 days out from the 14th of November. So first of all, second of all, what I wanted to just clarify was, I mentioned previously that it is important to get that September BAS lodged before you go on and make that declaration. Now, what I'm noticing is that once the BAS is lodged on an ATO perspective, it is taking about 2 or 3 days for the JobKeeper module for that particular business to catch up. So where this is important is once that September BAS is lodged and the JobKeeper module for that particular business has caught up, when you log on to that particular business on the ATO portal, it is automatically telling you whether you do or not qualify for JobKeeper 2.0, because it's automatically comparing the figures that were lodged on the September 2019 BAS compared to the figures that you've now lodged for the September 2020 BAS. And its systems automatically calculating whether the turnover is the 30% or more. So my point of this story is to really get your BAS lodged today or tomorrow, because it is taking the ATO systems, as I've said, I've noticed with a number of people, about 2 or 3 days to catch up. You can lodge the declaration without that BAS being lodged. However, I would advise against it, because it is, if you do that, then it is giving you the option. It's saying, do you want to then use these figures for your September BAS? So my advice is get that September BAS lodged as soon as you can, today or tomorrow at the latest, to give the ATO systems time to catch up, so that when you do go on to make that declaration for October to get paid for November, the ATO is satisfied that you qualify. So just another thing that I wanted to clarify today was, because I've been getting a lot of questions about this, and this is around sole traders that aren't registered for GST. So the question is are they eligible for JobKeeper 2.0? And the answer is yes. You don't need to be registered for GST to qualify for JobKeeper 2.0. Where the confusion comes in is when they talk about turnover. The ATO refers to GST turnover. However, once again, just to reiterate that point, you don't need to be registered for GST to qualify for JobKeeper 2.0, as long as you meet all the other eligibility requirements. That your turnover for the September 2020 quarter was 30% or more down on September 2019. Now, before we've talked about employees and eligible business participants. So a person who's operating as a sole trader, they would qualify under the eligible business participant rules. So then we next ask ourselves, right, are they going to be tier 1 or tier 2? So what are the tests to qualify for that? So if that eligible business participant has worked 80 hours or more in the month of February 2020, then they will qualify for tier 1. And then if not, they'll qualify for tier 2. And there is a fair bit of difference in those rates, as I mentioned a couple of minutes ago. You know, it's 1,200 a week versus 750 a week. Here's another question, because one of the other requirements is that you have had to have a ABN registered at the 12th of March, and you had to lodge a tax return for the 30 June 2019 period. So what happens if your business started after 30 June 2019? Well, then you can rely on some of the alternative tests. Okay, so you can reach out to me for more information on those if you fit into that category. Likewise, as I mentioned with those tier 1 rates, if you didn't work the 80 hours in that month of February, there are alternative tests available for those. So if you want more information on those, you can reach out and I can talk you through those. That's all from me today, Sam. I'm actually really interested to hear what's going on in the market, especially what happened over the weekend. So over to you when you're ready.
Okay, thank you very much, Ian. As always, I think everyone should be very glad to have you on board because of the real-time update that you provide us. That's obviously very useful for businesses to know and to act upon straight away. Amazing. Okay, so I'm going to cover off on interest rates and also the market. So I'll start with the markets first. Obviously, other than the Melbourne Cup running and an outside rank, led from the start to the end and made some people really rich. The Reserve Bank met, and as discussed last week and the week before, the expectation was that they would drop the rates, and they certainly did give a pre-Christmas gift to the mortgage holders with the reduction of the official rates to 0.1 from 0.25%. They also did operate in a bond market to impact a lower yield bond as it happens. So at this point in time, the banks have responded by making 1, 2, 3, but in particular the 4-year fixed rates for principal and interest repayments on an occupier as the battleground. And some of those have dropped their rates to 1.89 to 1.99%, almost a 1% drop for many of the lenders, as a way to, I guess, to firstly, lock in those customers for a longer period of time, stop them from refinancing, but making sure that obviously they're aligning themselves with the bond rates as well. At this point in time, it looks like as if they're taking the profit on the variable rates. So none of those have dropped as yet that I have seen. Some banks over the last 4 or 5 weeks have dropped their variable rates by very small amounts and very selectively by 0.05%, and where the loan to value ratio of those loans are less than 60% to 70%. So yeah, it certainly hasn't been widespread as yet. But definitely the variable rates on both investment and owner occupier hasn't changed, and also the interest only rates haven't changed. So the banks are still taking extra profit on those and potentially are siphoning some of that into the 4-year fixed rates, for example, but certainly are looking to essentially take a bit more from there as well. And of course, this also impacts the the self-funded retirees who have term deposits and cash in the bank, because they basically get nothing, right? So when the rates were 2.5% as a number, when you could get that, well, $1 million got you 25,000, which was like your pension. So now even $1 million invested gets you literally nothing. So this is a big conundrum for self-funded retirees. So obviously that's something that we need to see how the banks will respond. And I guess this is probably one of the reasons why the markets are also increasing, because that money needs to find a new place to make money from. Now, I want to just make sure that we talk about fixed rates a little bit, because obviously this is a new battleground. So obviously a benefit of the fixed rate is the fact that you know exactly what you're paying for the period that it's fixed. And provided that the environment is not dissimilar, then you're okay, because you run off the fixed rate into a similar rate later down the track. But if the rates are going to be higher, and let's say if the rates are 2% now and it goes up by 1%, it's 3%, well, essentially that's a 50% increase on your interest costs. And your repayments will also have to be adjusted as well. So you might get a rude shock and down the track. So obviously you want to make sure that you're paying off those loans as you go along. And of course, if you're breaking fixed fees, they can be expensive based on any economic loss that the lender is going to incur. Just today, we had a client who wanted to break their fixed rates. A $1.2 million loan is going to cost them just on $27,000 to break. So it's not worth them doing. Make sure that you engage with businesses like ours, or your preferred credit provider, and you review your loan before you decide to change. And it might also be worthwhile for you to just wait for 2 to 4 weeks until all lenders have come out with all the different service offerings, etc., before you act. Because there's above all, you got to remember that you live with your loan over time, not just at the moment of the settlement. So you got to make sure that it's suitable for you in terms of the personal needs. Now onto the markets. Obviously there's a lot has contributed to what's been happening. So we've just had a flip of the previous week. I came on and said the market's all down. Well, this week the market's all buoyed by the potential of Biden obviously getting in, and the confirmation that came through as well. And in fact, the market today have responded positively. The market's up 1.6%. So over the last week, the market was up 4.4% here. Property trust, industrials, and consumer discretionary type companies led the way. And obviously having less restrictions in Victoria helps as well. And I hope that, we end up with some type of at least Australian COVID bubble. So then within Australia, our movements are much easier. And obviously we'll have some normality other than going overseas. US, Europe, Asia markets all went up significantly over the last week or so. Now, of course, we know all about all the coverage of media about Biden and winning and so on. And obviously the market seems to be happy with it at this point in time. But to be honest, we still need to wait and see the aftershocks, especially the Trump's legal battle, if it's going to come or not, because obviously that's going to unsettle the market. And also seeing how Biden really performs in rebuilding the soul of that country once the honeymoon period is over, right? So that, there's still time to go. Right now, it's just talk. Now, you may have seen that the Senate is somewhat still deadlocked. This is an issue, and we're not sure how much they can really achieve, from getting, different legislation through. This is an issue that previous presidents also had as well. Anyway, overall, Biden at this point in time will be less positive for the markets because, their aims are to increase regulation and taxes, and probably spend a lot more, which means that the government debt will also continue to rise at a greater rate. And they'll be really reliant on inflation to inflation away the value of the debt that they have in time to come. So at this point in time, I guess, the focus will be on that the battling the largest second wave in the US, and we'll see how they respond to that in particular. Now, don't forget that he's not taking office until the 20th of January. So until then, Trump can still make noise and do certain things. And so wait and see, I guess, what that entails. For me, that's all this week. I'll update you about the aftershock of the election and what happens in the markets here, post obviously having the new interest rates going through, and we can go from there. Now, I'm just going to open it up to the panel if there's any questions from anyone to ask.
I had a question that was raised with me literally as we went live, Sam, about how can we tell whether our suppliers are trading whilst insolvent, and what are the indicators of that? Look, that's a whole new session. I might cover it in depth next week if everyone would be appreciative of that. But in the homework, let's set some homework for our viewers. I want you to go to your Xero, and I want you to look at, and it tells you how often the debtor pays. It tells you they normally pay in so many days. And I want you to look at the report of what it would have been pre-COVID. Are they paying more often post-COVID or less often post-COVID? So there's your homework. Xero is a fantastic platform for that. And if you don't have Xero, just have a look at the payment cycles of when your debtors are paying, and bring that information with you for the next session, because I will cover off what are the warning signs that your suppliers are trading whilst insolvent.
Great, thanks, Adam. Any other comments by the other panels? No? All good? Fantastic. Now, if there are specific topics that you want us to cover off, viewers, questions you might want to have or post to the panel, please visit our Facebook page or the YouTube channel and make the comments down below, and we'll certainly have a look at those and look to cover those off for you in our sessions as we go. And so with that, we'll bring the 26th episode to an end, and I normally end those with a quote. So today, I'm taking a wife of a Democratic leader, Michelle Obama's quote: "You may live in the world as it is, but you can still work to create the world as it should be." And with that, have a wonderful week, and we look forward to engaging with you again next week.